you all know what prices, right? So if I ask you, why do stock prices move all the time? You say, well, companies announce new products, and that's a little bit weird, the feedback there. And they release annual reports and press releases all the time to the media. And the financial news media reports about market trends and stock price movements all the time. And more recently, tweets move stock prices as well, right? So in short, stock prices move because of new information, right? So the question is, how does a trader benefit from all of that information? Well, there are two things to keep in mind, right? First of all, you have to be first, right? There are lots of other people who would like to have that information, trade on it. So when the market knows the information, when information becomes widely available, the trading opportunity is gone. So you got to be first. And nowadays, it's not enough to compete with other human beings for being first, right? Nowadays, you have to compete with computer algorithms. I think like 75% of trading volume on a given day is done by algorithms, not by humans anymore. Right? So that raises the question. How do you make money in today's markets? How do you trade on information? Well, some traders have superior knowledge. Right? They have a great brain. If you listen to the stories about successful people, you always hear that great traders, great CEOs, they read a lot, right? But it's also possible that people benefit from their personal connection. They get information through their personal networks. And that is the type of question that we are investigating in this study, right? So we want to know, how does material non-public information flow from corporate insiders to traders? Right? And if I phrase it like this sounds like a daunting talk, a daunting task, right? Because everybody can be an insider. This guy might have something important in his head that would be valuable to a hedge fund manager, right? So it's kind of not possible to investigate this question. We can't possibly look at all corporate insiders, again, because every employee can be an insider. So we are focusing on a group of corporate insiders that are easily observable and that clearly have privileged information. And those are the directors, right? The people who make up the corporate board. Right? And of course, then the question is, well, who are the traders? Who are the people on the other end that potentially get that information? And if I could, right, I would love to have all the trades that sophisticated traders make. I would like to observe the information they receive, and I would like to know how knowledgeable those guys are, right? But of course, that's all unobservable, and the people who trade on sensitive information, they have incentives to disguise their trading behavior, right? So ideally, right, if you would endow me with subpoena power, I could get all that information. But actually, even if you have that subpoena power, it's difficult, right? So in 2011, there was a famous insider trading case called the Galleon case. And the FBI actually tapped 550 different individuals. They had recorded 550 different individuals. They had over 18,000 wiretap recordings. And lo and behold, they had very little smoking gun evidence on their tapes. What do you think that is? Well, directors watch the wire as well, right? So they're not going to say anything on the phone that could incriminate them. So it's not that easy, even if you had disposable to all of this, Big Brother is watching you technology, to observe the thing that we really would like to see, the information flowing, right? So because of that, what we are doing in this paper is a little bit like inferring what's going on from kind of looking at tracks in the snow, right? So let me tell you a little bit more how we do this. And I just want to kind of point out that it's not clear at all that we're going to find a relationship here, right? Why not? Well, because those guys, those traders might either not get the information or they just, might be too clever to actually hide what's going on. So previous research has shown that there are certain groups of traders that are particularly well informed. Right? Short sellers, option traders, institutional investors. Most of you in the room here know what a short seller is, right? That is somebody who benefits when stock prices decline. Right? How do you do this? You borrow stocks that you don't actually own and you sell them. And if you're right and stock prices decline subsequently, you can buy back those stocks on the open market at a lower price, return them to the institution you borrowed it from, and you make a profit. Right? Similarly, option traders are able to, in a sense, can take a leveraged position on a stock. Right? And so you have all those people that trade in the stock market, that short, that options, and previous finance research has shown that if those guys trade, often stock prices move in the directions of their trades. So they know something ahead of the competition. Right? So what we are doing is we are looking at aggregate trades of those groups. So let me rephrase the question. How does non-public information flow from corporate board to short sellers, option traders, and institutional investors? Right? And again, there might be no link, because if lawyers do a good job, they should draft non-disclosure agreements that prevent people from actually spilling the beans, so to speak. Right? So corporate directors have a fiduciary duty to keep privileged information private. Right? And they all sign non-disclosure agreements, so it's possible that we don't find anything. But there are three different reasons or channels, so to speak, through which information can travel. First of all, people make mistakes. Right? It's possible that information leaks out because of mistakes. Second of all, we have a bunch of SEC insider trading that document that there's tipping, right? Where corporate directors deliberately divulge information to traders so that somebody else can profit of that information. And then finally, hedge funds are smart, right? The people who work for hedge funds are highly incentivized to dig up information that nobody else knows. Those are pictures of oil tanks. Oil tanks have lids that float. So if the tank if the tank is almost empty, then the lid is. So there are companies that sell pictures of major oil tanks around the world so that hedge funds can gauge the oil supply around the world faster than competitors. They use the same technology to measure how full parking lots in front of major retailers are, like Target or Walmart, so they sales data faster than the competition. Right? They pay off employees at airports to track the movements of corporate jets, and so on and so on. So there are many examples where hedge funds use all kinds of ingenuity to figure out information that the rest of us does not get that quickly. Right? And it's possible that that is the mechanism. Right? We can't really tell you how exactly the information flows. Right? So some boards are more connected, and we hypothesize that directors that just have more connections, right? They provide more information transmission to traders. And directors that are less informed, they have smaller networks that you just see less information leakage. Right? So we have a database from BoardX that you can imagine like LinkedIn for corporate directors. Right? It's a way to measure how connected a director at major US corporations are. And we use this to create measures of board connection, right? So imagine that you take all the companies and line them up based on how connected their boards are, right? And then you group this into three groups actually. We have the least connected boards, and we have the most connected boards, and then we have a group in the middle, right? So we expect that there is less information flow from boards, from companies to sophisticated traders if the board is fairly unconnected, and more information flow if the board is relatively connected, right? So that is one part of the investigation. What is the big problem here? Well, the hypothesis is nice and well here, but again, I told you we don't observe the information, right? So if you picture a trader as a goldfish, they're not talking to me, right? They are not talking to anybody. So how can I figure out whether or not, the trader knows something? Well, I have to infer this from traders' actions, from their behavior. If they take specific actions, right, they probably know something. That is the identifying assumption here, right? So let me tell you how we do this. Imagine we take one of those groups. Let's say we take the group of the most connected companies, right? And then you take all those and sort them based on how many actions, so to speak, how much is going on among the sophisticated traders, right? So you have the companies with very low short interest. That suggests they don't know anything bad going on in the companies. There's not much flow that tells you something is, about to happen. And then you have the jumping fish. The companies where short sellers actually short a lot of stocks. They borrow stocks and then sell them because they expect that prices are going to drop. Right? So we are arguing that there's more of an information gap between those two different groups if the board is connected. So imagine, right, we are comparing the performance of companies with low short interest to the performance of companies with high short interest, conditional on both of them having a very connected board. So what do we see? Well, if there's little short interest, stock prices actually go up the next months. Right? There's going to be a positive abnormal return. The sophisticated traders don't think anything is going on, anything bad, and they are right on average. And for the other group, we find that stock prices go down. Right? So if informed traders trade a lot and short the stock, they tend to be right. So this difference is more than 1% a month, abnormal return. So we are risk adjusting the return. And we find this not just for short interest, but we also find this for other measures of informed trading. So if we look at option traders, or if we look at institutional investors. Right? So short sellers, option traders, institutional investors, they are all more informed when trading companies with more connected boards. And then we do a couple of other things in the paper because we are interested in understanding channels. So we are not the first one that show that short interest predicts lower future stock returns. Right? There's an entire literature out there. Fairart has written a couple of papers to show this in different settings. But what we show in this paper is that this annualized underperformance is 5.4% larger for connected boards. So the effect is much more pronounced if the directors are highly connected to other business people. Okay? So this pattern persists throughout the sample period, but you can see there's time variation, right? So the effect was particularly pronounced at the beginning of our sample period, and at the end, During the financial crisis, right, not that much. And again, the same thing works not just for short interest, but also for other measures of informed trading. So the last thing I wanted to tell you is that, there is other corroborating evidence that's kind of consistent with our story. So one of the things that we do is we investigate information flow around earnings announcements, right? And so we find that sophisticated traders better anticipate earnings surprises in firms with more connected boards. Right? Every quarter, a company announces earnings, and there's always a big guessing game going on in financial markets on whether they meet or beat or not meet earnings. And kind of consistent with our story, traders are more often than not correct if they trade in firms with more connected boards. And then also what we do is we look at subsequent news sentiment. So the way we do this is we take a database of news stories and use computational linguistics to figure out whether the tone tends to be more positive or more negative. And if short sellers short a lot, lo and behold, the stories that come out about the company subsequently, they are more negative. Right? So why do we see that? It might be information leakage, it might be tipping, or it might be that for companies with highly connected boards, they're just more attack vectors for hedge funds and sophisticated traders to ferret out information. Right? So we can't tell you whether those guys do anything that's patently illegal, but we can definitely show that there are tracks in the snow. Right? And so this study has been published in the Journal of Accounting and Economics last August, and there's a blog at Harvard Law School that also wrote up some information about the research. And one of the three co-authors is not in the room here. Ferhat is here. Gide is not, because he's currently on loan, so to speak, at the Securities and Exchange Commission. And the SEC is always interested in understanding how to use big data to investigate insider trading. That's all I have. Thank you very much for coming. I really appreciate the great turnout here. Thanks to whoever is watching this right now. And last but not least, thanks a lot to Lauren and Michael. Sound like a guy on SNL, for setting all of the technology up here. So thanks a lot.